close to that 52-week high. We've got lots of positive brokerage views coming in as well on the bank. So wanted to discuss the outlook with Mr. Kamakoti, who's the MD and CEO. Mr. Kamakoti, loan growth was strong in the first quarter, and some brokerages have tweaked estimates to 18% going forward. What are the trends you're observing, and what's your guidance for FY20?
When we started the year, we expected the growth rate for the current financial year to be between 15 and 20%, somewhere closer to 18%. But looking into what is happening around now, we are very careful. Particularly, we have tightened our credit underwriting and things like that. If things get better as we get into the second half, we may get closer to that number. But the downward risk is definitely there.
Fair enough. You were also geared toward the commercial, MSME trading and agri sector. What cues are you getting from the market? Is the ground reality as bad as been reported? And what are the prospects on your asset quality?
One thing which we have to clearly share is that we don't see things as bad as it is being perceived, or it is being perceived as if total doomsday in that segment and all. It is not that way. Definitely things are stable. We are able to see that, but some amount of pressure on the growth of individual customers are definitely there, but it is not as bad as it is being perceived from outside.
Okay, fair enough. Now, your net interest margins have been strong, but, they tend to contract when the interest rates fall. So what is the trajectory for your net interest margins? Are you going to maintain the current levels?
It's particularly after the arrival of external benchmark rating, this is something which we have to closely look into. In fact, even during the last interest rate decreasing cycle, the margins did not contract as we expected, which we had been continuously sharing with the investors during the con calls and all. So if you had a chance to look into our last 50 quarters of performance, at least for about 42 quarters, we typically used to have about around 3.4 to 3.7% as our net interest margin, and the past 5-6 quarters it has been well over 4. Definitely, as we have been communicating, this level never had been a sustainable level for us, but it has happened because there were supply side issues, particularly on the credit growth side. So we feel we have to wait and watch, particularly what is going to be the impact of the floating rate, to what extent the market interest rates will come down, because we are seeing contradictory signals. Like say, on one side we see the interest rates on repo coming down. At the same time, you have 10-year bond yields and all inching up from their low. There are contradicting signals, and we have to closely monitor what is going to happen in the market. But definitely we are into a decreasing interest rate scenario. That is what our take is.
Sure. Okay. So, 20% of the book comes from the agri sector. How crucial has the rainfall been to the overall health of the sector this time around? It seems to be sufficient. We've seen the impact on the rural economy, the distress. Are you seeing rising NPAs on the back of that, or have you been insulated largely because of agri financing done perhaps via gold loans and the like?
Yeah, you are right. At the same time, particularly for this current season, the monsoon for Tamil Nadu, which is our focus area, where we have almost 90% of our agricultural financing is in. We feel this year things should be okay, better, and it should also be helping the overall economic growth and rural demand to pick up towards the maybe third or fourth quarter of the current fiscal.
I just want to understand, all of corporate India is really loading the overall corporate tax cut. I want to understand what the impact is on the bank or on your sector. Are you seeing any major benefits, and where exactly will the additional capital as well be deployed?
Absolutely. The back of the envelope calculation for us, the preliminary estimates make we should be saving close to about 60-70 crores in the net tax liability for the current financial year. That is definitely going to help us both in terms of some profitability growth and whatever incremental provisions, if at all needed. It's already an extra cushion which is available for the current financial year, which we have liberty to use as we would like them to use.
And are you seeing any stress in the SME book?
See the stress level. We don't see anything like say too much different from what we have been seeing over the past like say 6 to 9 months. Two things which we want to emphasize at this point of time. One, typically we like say up to for 10 years up to financial year 2014, we typically used to have about 1.25 to 1.5% slippage. From the financial year 2014-15, it almost doubled to 2.8%, from where it has incrementally started coming down. And last year we had a slippage ratio of about 1.9% to the closing advances, which that number we feel we should be able to achieve for the current year also. We don't feel anything incremental stress on that. Number two, probably you may remember the dispensation given by the RBI for restructuring of the SME sector on the first week of January. When we started taking that to our customers, if at all those who are having, like say, if they would be interested in taking the dispensation and all, we are not getting many customers who are who would like to take that dispensation, which means that their confidence on the overall performance, the way they will be able to handle this slowdown is definitely, particularly in this geography where we are operating, is reasonably strong. And we don't feel any major issue because of the slowdown. Yes, I don't say that you are seeing rivers of milk and honey is flowing, but definitely it is not so bad as it is being perceived from outside.
All right. Thanks very much then for giving us an on-ground situation as well as telling us what the outlook is on your financials. That's the word coming in from City Union Bank.